10 years after the iPhone exploded into our hands, cryptocurrency is still in its equivalent of dial-up internet. Despite 560 million global users and surging developer growth, most people ask, have we already missed the crypto revolution? History shows that massive technologies often start in obscurity. The stakes are simple. Early adopters can shape the future, or, like the internet, they risk being left behind. So, is it really too late? Or are we still at the beginning of something even bigger? Mosaic, the first widely used web browser, appeared in 1993. At the time, the internet was a curiosity, mostly home to researchers and hobbyists. 2 years later, Netscape went public in 1995, and the world caught its first glimpse of what a digital future could look like. Yet, even then, most people didn't have an email address, and online shopping barely existed. 12 years after Mosaic, Apple launched the iPhone in 2007. The smartphone era began not with instant ubiquity, but with a single device and a handful of apps. It would take another decade before billions carried the internet in their pockets. Bitcoin's Genesis block was mined in January 2009. In those early days, sending or receiving cryptocurrency required technical know-how and a leap of faith. It wasn't until 2015 that Ethereum launched, introducing programmable smart contracts and laying the groundwork for decentralized applications. Each milestone, from Mosaic's first web page to Ethereum's first block, landed quietly, long before mass adoption or mainstream headlines. Viewed side by side, these timelines reveal a familiar pattern: breakthrough, slow build-out, and then, eventually, a tipping point. The internet's first wave took over a decade to reach a quarter of the global population. Smartphones followed a similar arc, moving from early adopters to everyday essentials over years, not months. Cryptocurrency, now more than 15 years old, still sits closer to the beginning of its journey than the end. The big moments: Mosaic in 1993, Netscape's initial public offering in 1995, the iPhone in 2007, Bitcoin in 2009, and Ethereum in 2015, each set the stage for what would come next, but none offered instant transformation. Progress in technology is rarely overnight. It's a long ramp, measured in years of quiet growth before the world notices. Cryptocurrency's global footprint is now visible in numbers that were unthinkable just a few years ago. In 2024, over 560 million people worldwide own or use crypto, an increase of nearly 40 million in just 6 months. That's about 6.8% of the global population, putting crypto adoption on par with the internet's early 2000s era. The story isn't just about users. Behind every new wallet, there is a surge in developer activity. Open source platforms like Ethereum, Bitcoin, and Solana have seen record numbers of code contributions. On GitHub, developer commits for smart contracts and blockchain infrastructure are at all-time highs. While the number of builders still trails open-source giants like Linux at similar ages, the growth rate is unmistakable. The open-source snowball effect is in motion, with each new project attracting more talent and experimentation. Stablecoins, digital currencies pegged to traditional money, now play a central role. In 2025, stablecoins account for nearly 30% of all on-chain transaction volume, moving over $4 trillion in a single year. They have become the backbone for cross-border payments, remittances, and savings in economies facing inflation or unstable currencies. For millions, stablecoins are not just a speculative tool, but a financial lifeline. What are all these users and developers actually doing? The numbers point to a growing community building transacting, and experimenting with new forms of value. From everyday savings to global payments, the data reveals a technology in the process of scaling, still early, but expanding into the routines of regular people and businesses. Mike Winkelmann, better known as Beeple, spent years posting digital art online, watched by thousands but earning little more than likes. In 2021, he minted a collage of 5,000 daily pieces as an NFT and sold it at Christie's for $69 million. The sale did not just break records, it introduced a new way for artists to earn a living from digital work. For the first time, creators could sell verified originals and keep earning a percentage every time their art changed hands, thanks to royalties coded into the NFT itself. This automatic payout system means artists are not locked out of the value their work gains over time. Beeple's headline-grabbing auction proved the model works at the highest level, but the same tools are open to independent creators everywhere. NFTs have turned digital art from a side project into a sustainable career, with royalties arriving automatically each time a piece is resold. At a small cafe on the edge of a college campus, the owner noticed a steady stream of international students asking if they could pay with crypto. In 2019, she decided to add the option, choosing a point-of-sale system that accepted Bitcoin, Ethereum, and stablecoins. Setting it up took less than an hour, just a few clicks to connect her bank and verify her identity. Staff needed a quick tutorial, but the real challenge was helping customers scan QR codes and send payments from their phones. Within weeks, crypto sales made up about 2 to 4% of her weekly transactions. Most of those customers said they would not have bought coffee if crypto had not been accepted, especially students from countries with strict banking rules. The system instantly converted crypto to dollars, so the cafe never had to worry about price swings. For the owner, it was not about replacing cards or cash. It was about giving people another way to pay and reaching customers who otherwise might have walked away. A software developer in Berlin needed a quick loan to cover moving expenses. Instead of filling out paperwork at a bank or waiting for approval, she opened a decentralized finance app. By depositing some of her Ethereum as collateral, she borrowed a stablecoin pegged to the US dollar, with no credit check and no middleman. The process took less than 10 minutes. The catch was this: if the value of her Ethereum dropped too far, her collateral could be liquidated automatically. She kept a close eye on her health factor, a number that measures how safe her loan is from liquidation. On good days, the system felt empowering. She could access dollars, pay bills, and repay at her own pace, but the rules were strict and enforced by code. A sharp price drop in her collateral would trigger a sale, possibly wiping out her deposit. Programmable finance offers speed and flexibility, but it also demands vigilance. For millions of people, this new model is a way to borrow without banks. The risks are real and ever-present. Visa's USDC pilot in 2021 offered a glimpse of how major payment networks are testing blockchain rails behind the scenes. By settling transactions in stablecoins directly on Ethereum, Visa shortened payment windows from days to minutes for select partners. The pilot was small, but it set a precedent, and other payment giants soon followed with their own experiments. Meanwhile, firms like Coinbase Custody and Fidelity built secure storage services for digital assets, providing the kind of institutional-grade custody that pension funds and endowments require. In early 2024, the first spot Bitcoin exchange traded funds gained approval in the United States, opening the door for mainstream investors to buy crypto through familiar brokerage accounts. These moves bring new layers of oversight and infrastructure, signaling that digital assets are no longer just the domain of early adopters. The path from pilot to product isn't instant, but each step draws more established players into the fold. Every technology with promise also carries risks, and cryptocurrency is no exception. Wild price swings can wipe out savings in hours, as seen on March 12, 2020, known as Black Thursday, when Bitcoin lost nearly half its value in a single day, and Ethereum dropped over 40%. That same day, the MakerDAO protocol, which manages the DI stablecoin, suffered a cascade of liquidations. Network congestion pushed transaction fees so high that some auctions cleared collateral for almost nothing, leaving users with heavy losses and a deficit of $4 million. Scams, technical bugs, and sudden regulatory changes remain ongoing hazards. For every story of innovation, there are cautionary tales that remind users and builders alike. This is still an experimental system, and vigilance is essential. Right now, over 500 million people use crypto, yet most use cases are just emerging. As institutions and individuals build new systems, the next chapter isn't written, it's unfolding. The real question isn't if you're too late, but whether you're ready for what comes next.